In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. So we're going to talk about the price action over the past few days, the company itself, and any recommendations regarding if you should be buying, holding, or selling the shares. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are updated, and their timeliness about the latest market updates. The videos are typically recorded the day before and scheduled for the next day. This means that if there are significant volatile movements during the trading day in which they're posted, it'll not be reflected in the video because I work during the day. And this is why, to the extent possible, my analysis will be based on the medium term and not the intraday movements. Because either way, most of you watching are keeping a position open for at least a few weeks and not to buy and sell within the same day. Of course, if the intraday movements are significantly enough, they can modify our outlooks, right? So if they're significant enough and happen after my videos, either they will not affect the overall picture, or if they're significant enough, it'll be mentioned in the next video about the stock, with possible reevaluations of the circumstances as needed. And of course, if you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. Vinco Ventures is a company working on consumer and digital products, and its main asset is the video platform it recently acquired and planned to expand in India. The reason why the stock is so popular is because on one hand, the company is going through a phase of expansion and possible mergers. On the other, it's because Vinco is having a huge amount of short interest, which can then be reversed into a spike of demand for longs. The way short selling works is that the stock will be borrowed from brokers, sold in the market, and then recovered later, with the expectation that in the meantime, the stock price has decreased. Short squeeze would rely on recovering those short positions that would create a significant additional boost to its stock price when they're recovered, which will increase their profits even further. Over the past few days, the stock price initially went to $8.60 around October 18th, before retracing back to $5.60 in the after hours trading on Friday. This means that the stock is meeting both the pressure of short sellers, the downward pressure of the tech sector at large, and some negative reactions due to the changes that happened with the senior management and executive officers. When we look at the trading volume, the stock has been trading between 35 million shares a day to around 85 million shares over the past few days. This trading level is comparable to the average, but still slightly lower than the previous days and weeks, where the stock traded at around 140 million shares at one point. Another thing that is potentially weighing on the stock price of BBIG is that there may be a merger coming down the pipe for the company, and that there may be a complete overhaul of how the shares are distributed, as well as the impact it may have on the options. Careful, I said may, because we don't know the details yet. But while some believe that this merger, currently not announced on Vinco's website, but suspected to exist because it recently filed an S1 form on October 21st, will have a positive effect on the stock, personally, I would advise more caution about the merger. Specifically because we have to remember about what happened to the merger with Support.com and the fiasco that followed regarding the merger. I would like to advise to remain in this position just because, yes, some of them may be right, like the volatility that is upcoming may be a huge positive one as well. But you need to assess your own risk appetite with Vinco and your risk profile in general in order to see if the stock is for you. But regardless of the circumstances, I would say that the maximum exposure to BBIG should remain at around 1% of your portfolio. In the meantime, if you want to buy more shares, then it's up to you. But I would say that although the entry point is decent, keep your position at the 1% above mentioned. Looking at the current environment, I think that we have to be careful with having exposures in the equity market. The market has been predicted to eventually go through major pullbacks or even a recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the quantitative easing years and the drastic increase in asset prices with the collapse of their yields, we gotta remember that the market doesn't mirror the economy. Otherwise, we would have been trading in a sideways market for years. 2020 saw another big push in asset prices, and this time it's not just for the blue chips but also growth stocks. There are generally two explanations. The first one is that more money has been printed across the world or has been printed across the world. And because of the real economy stagnation over the years, the capital then entered the huge melting pot of globalized finance and has been buying up shares ever since. That was the case for quite a while, but now that QE has been touching its end in North America and slowing down in Europe, I don't think that this will continue to be a key factor to keep asset prices up or higher in the years to come. But this decrease of new money is partially compensated with the increase of geopolitical tensions across the world. And the more tensions there are, the more capital tends to flow to the US, because it is still perceived as the ultimate safe haven, especially from countries that are having turmoils or social unrest. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to buy in specific sectors that are very hot at the moment so that everybody can keep playing the game of hot potato. This does, to some extent, protect the capital of those who are not the last in that game of hot potato. But for the last one, well, tough luck. What all of these mean for the market is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession is building up after the party in 2020, and the recent announcements from the US Federal Reserve about the possibility of a recession in the short-term future all contribute to a higher degree of inherent risk in owning securities. They also led me to conclude that it's very critical for this period of time to keep your speculative plays at a reasonable level. A good portfolio typically has most of its positions in sectors that are different and mature, with stable and predictable cash flows like REITs, fixed income, and preferred shares. The rest could then be invested in growth stocks or remain cash heavy in case there's an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities to average down the cost basis, and that's why the initial position should remain small so that later down the road we can afford to average down. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.